Hello all and welcome to the case study presentation for Financial Management MBA 6003 for the summer 2017 semester by Allan Lewis, Justin Rush, and Rawan Hourani. This presentation will focus on Kingston-Murray Enterprises, otherwise known as KME, and the dilemma they faced on how they want to finance their current and future operations. Kingston-Murray Enterprises is a natural resource exploration and mining company and is also publicly traded. Resource exploration is a capital-intensive business sector with a deferred payback model. This is due to the fact that resources can be very expensive to extract and thus results in a high operating costs for the extracting company. Due to this business model, usually the costs can only be repaid after the resource exploration and extraction is completed. This can also make it very hard for companies like this to match their revenues with their expenses. Kingston-Murray Enterprises currently has a debt rating of BA. This is lower than the required BAA level it would take for Kingston-Murray Enterprises to obtain institutional financing, or financing from a traditional bank or lender. Kingston-Murray Enterprises is working to improve its debt rating of BA, but for now, they will have to make do with what they have and seek alternative financing methods, as they are seeking $500 million in operating cash in order to develop recent gold, sulfur, and other resource discoveries. One common method of financing for a company would be to issue straight bonds. However, there are disadvantages to this. First off, issuing straight debt like this would counteract the effort that KME is making to improve their overall debt rating. In addition to this, due to their debt rating, KME would have to pay higher returns on the investment due to the elevated risk that investors are taking. Another common way that companies raise money is to issue stock. However, this would have many disadvantages for KME as well. First, when issuing common stock, KME will incur many other fees and flotation costs involved. Second, the company would likely have to offer discounts on the stock in order to entice purchasing decisions from investors. A new issue of stock would also dilute the current shares and likely make them worth less, causing the stock price to drop. Issuing new stock is particularly unattractive when the board of directors thinks the stock is undervalued. Issuing new stock when your shares are undervalued is essentially offering the public a discount to buy the stock. This undervaluation will also result in KME acquiring less capital from the stock issue than they would have otherwise gotten if their stock was appropriately priced. Typically, a company will only issue new stock when the board believes their stock is overpriced. This would allow them to acquire more capital than they would be able to get using other traditional financing methods. Finally, from a public opinion perspective, issuing new stock emits negative signals about the company and could further lower the stock price. This is something that KME and all companies must take into consideration when issuing new stock. Now that we've discussed the disadvantages of issuing new stock as well as issuing straight bonds, it's time to discuss other financing options that KME can use in order to obtain funding. This option that we will focus on the rest of the presentation is a liquid yield option note, otherwise known as a lion. Lions are very flexible and they can be tailored to suit the specific needs of a company. These bonds can be converted into stock, and this allows the company to pay a lower interest rate than a straight bond. This zero coupon bond also defers any payments until maturity, which allows for superior cash retention than other methods. The type of investor that would be most interested in owning a lion would be a non-institutional investor. Non-institutional investors refer to individual people as opposed to entities like banks. Advantages for the investor include low buy-in costs since the bond pays no annual interest. Because of this, these zero coupon bonds can be bought at a deep discount to their face value. Like mentioned earlier, the lion has zero payments annually. However, investors must still pay taxes on the accrued interest. This is one big reason why non-institutional investors would be more interested in owning lions than entities would. In addition to the advantages provided to investors, there are also many advantages for the issuing company. Issuing companies are able to receive financing without the obligation to make annual interest payments, and no payment is due until the lion matures. The discount offered on the face value of the lion can also be amortized as a tax-deductible expense. And like other bonds, the issuing company, in this case KME, has the right to call the lion prior to its maturity date. Now, we will use an analysis to quickly break down the value of the lion. For this analysis, we'll use 2 coupon payments per year and 15 years to maturity. The going annual rate will be 12.12%, and the annual payment will be $0 since, like we discussed earlier, lions don't pay any annual interest, and the par value will be $1,000. Based on the inputs we just discussed, the present value of the straight bond is $171.18. As you can see below the analysis, the proposed initial price of KME's lion is $196. This is slightly higher than the straight bond value due to the increased flexibility of the convertible bond. In this case, the difference between the issue price and the straight bond value is the premium that the investor is going to pay for the conversion terms of the contract. This is essentially the option to convert the bond to a predetermined number of shares at the choice of the investor. Now let's move on to the lion value decomposition and analysis. Because lions are essentially zero coupon bonds that can be converted into stock, it's important to understand the conversion value and how it comes into play in this situation. In order to find the conversion value of the convertible bond, we can take the issue price set by the company and then subtract the value of the straight bond. This calculation will give us the conversion value of the lion. As you can see in this case, the conversion value will be the lion price set by KME minus the present value of the straight bond. As you can see on the slide, the lion price that was set is $196 and the present value of the straight bond is $171.18. This makes the conversion value $24.82. Now that we understand the concept of conversion value, we can see that investors in Kingston-Murray Enterprises Lion would be willing to pay an extra $24.82 in order to attain the terms of the lion listed on the slide. These terms include the ability to convert to Kingston-Murray Enterprise shares at about a 1:6 ratio and 2 put provisions at 5 and 10 years at about $414 and $643 respectively. With all this being said, there is a risk of early lion conversions for the company. Before going into depth and analyzing the negative outcome of early conversions, let us first define the conversion premium. A conversion premium is simply the amount difference by which the price of the convertible security is above the current market value of the common stock that it can be converted to. When the conversion premium falls, the yield of the bond also declines. Recall that the yield of the bond is defined as the annual coupon divided by the market price. Thus, when the stock price increases, the conversion premium decreases, causing the conversion value to increase. As a result, the yield of the convertible also decreases, and sometimes to a point below the dividend yield of the underlying common stock. If this occurs, investors will definitely choose to convert early and get higher cash flow. If or when investors choose to convert early, it can have negative consequences on the issuing company, the first being increased dividends to shareholders. The more shares a company has, the more dividends it will have to pay out, and the retained earnings will be affected as well. The second consequence is as conversion premiums decrease, the conversion rates are higher, and this can increase losses for KME as a whole. Other risks include diluting the overall company stock, as well as the potential loss of control as more and more shares are converted into common stock. There is no doubt that lions are a complex type of financing that we do not hear about frequently today. However, this type of complex and structured financing is necessary in today's world. Traditional lenders normally do not offer this type of financing, which makes structured and complex financing like this crucial for many companies and other businesses. This is particularly true when a company does not have a good credit rating. just like the case of Kingston-Murray Enterprises. Traditional lenders also usually lend in traditional ways, and when companies have specific needs, like in the case of Kingston-Murray Enterprises, this type of structured and complex financing comes in handy. In addition to this, companies can transform cash flows and liquidity and do all of this without necessarily increasing the risk for the investor. One current and common example of structured finance is the collateralized debt obligation, or in other words, a CDO. CDOs are generally cash flow generating assets that are pooled together and then sold to investors. The name collateralized debt obligation comes from the fact that all of the assets in the pool are essentially debt obligations, for example mortgages, bonds, and other loans. The advantages of a CDO from an investor perspective are the fact that the investor can determine the amount of risk they would like to take on, as well as determine the tenure of the investment itself. In conclusion, it is clear that the Lion offers many advantages to both investors as well as the issuing company, in this case Kingston-Murray Enterprises. Given the facts, including KME's current debt rating and the prevailing thought that KME's stock is undervalued, and it is clear that Lions or zero coupon bonds would be an excellent option to raise funding over alternative methods such as bonds or issuing new stock. The Lion also supports KME's current business structure, seeing that they would be able to raise a large amount of cash now without having to worry about making annual coupon payments. This strategy would give KME the funding they need for their resource exploration and the time it would take to achieve the cash flows necessary to pay back the investors. The individual investors would also benefit since they can convert their bonds to common stock or simply hold them until the maturity date. With all this being said, KME should certainly move forward with the plan to use Lions to raise funds for its business. Thank you for watching this presentation on the case study of Kingston-Murray Enterprises as it relates to liquid yield option notes, otherwise known as Lions.